Shall we continue? Now, what I was trying to tell you was we only considered the amounts of the land values at the beginning of the period. So you will notice that we are not deducting the gain, unlike in the other solutions in problems 1, 2, and 3. This time, we are not deducting the gain because we are recording the land accounts of both companies at their cost at the beginning of the period. In other words, there was no sale yet at the beginning of the period, and so the balances given were before the transfer of land with the corresponding values. So we now get 416,000 and 256,000. Okay, total there. Number 4 is letter A. Class, can you hear? Can you hear? Hello?
Yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Ay, kay brown out di sa akon. So this time naka ano lang ako, naka go 50, go 90. But I'm not sure if you can hear. So okay lang. Oh, okay lang. Sige. Ang hindi ko lang di magwantahan ang init. Okay, so number 5. In number 5, we have now your MM company hold rights for the machine for 100,000. If the intercompany sale occurred on January 1, 20x4, and the production rights are expected to have value for 5 years, at what amount should rights be recorded in the consolidated balance sheet for December 31, 20x4? So your answer would refer to the cost incurred by BB to develop the equipment, a research and development cost, and must be expensed as they are incurred. So research and development cost and should be expensed when they are incurred. Transfer to another legal entity that does not cause a change in accounting treatment within the economic entity. Okay, so for that, our answer is 0. So letter A. I'll repeat the reason. The cost incurred by BB to develop the equipment, a research and development cost, and must be expensed as they are incurred. Transfer to another legal entity does not cause a change in accounting treatment within the economic entity. So the cost incurred by the subsidiary to develop the equipment, actually they are not charged to the equipment account, but to research and development costs, which are to be expensed. Okay, we go to number 6 to 8. On January 3, X6, Pilot sold equipment costing 100,000 to its 100% owned subsidiary, Silox, for 80,000. At the time of the sale, the equipment had been 50% depreciated using the straight line method and unassigned life of 10 years. Silox continued depreciating the equipment by using the straight line method over a remaining life of 5 years. What are the costs and the accumulated depreciation, respectively, of this equipment in the December 31 X6 consolidated balance sheet? So we are asked now for the cost and the accumulated depreciation. So for number 6, we have now the original cost given at 100,000. Okay. Then we have the accumulated depreciation January 1, 20x6 in the amount of 100% times, no, 100,000 times 50%. 50% because, as stated, the equipment had been 50% depreciated using the life of 10 years. So we just multiply 100,000 by 50%. That gives us the accumulated depreciation up to January 1, 20x6 in the amount of 50,000. Then we add the additional depreciation equivalent to 50,000 divided by 5. We have 50,000 because the remaining book value is still equal to 50% of 100,000. So the book value is 50,000 divided by a remaining life of 5 years. So the additional depreciation, that's for the year 20x6, is 10,000. 50,000 divided by 5. So 10,000, we add it to 50,000. The total is 60,000. So 100,000, that's the cost. And the accumulated depreciation total is 60,000. Is 60,000. So in other words, the answer to number 6 is letter E. Okay, then we go to number 7. What is the amount of intercompany profit or loss that must be deferred of at December 31, 20x6 with the sales price given at 80,000? And we have the book value at the cost of 100,000. We deduct the accumulated depreciation of 50,000. In other words, the book value is 50,000 as computed above. So we now have the difference of 30,000. 80,000 minus 50,000. We have the difference of 30,000. That is the unrealized gain. And we deduct the realized gain. We have to amortize the gain of 30,000. We divide it by 5 years, the remaining life of the asset. So we now get 6,000. That is the realized gain. So the unrealized gain is still 24,000. That's the unrealized gain. So number 7 is letter D. What is the deferred intercompany profit? Deferred or unrealized. So if the total gain is 30,000, you divide that by 5 years. Every year you have to amortize and realize the amount of 6,000. Okay? Now in number 8, what is the amount of the adjustment to depreciation expense in preparing the consolidation worksheet on December 31, 20x6? So we now get the amount of 6,000. That's the subsequent to date of acquisition. The amount of, we have now number 8 is 6,000 or letter E. Our entry is to debit accumulated depreciation and to credit depreciation expense. That's the adjustment to depreciation expense. Why do we have 6,000 here? We have 80,000. That's the original cost. But the book value, 80,000 is the selling price. Okay, the selling price. Then from that, we deduct 100,000 times 50%. So we have 30,000 as the unrealized gain. And then we divide that by 5 years. So it's an amount of 6,000 a year. 6,000 a year. Now, what will be your entry? We now debit to accumulated depreciation and to credit depreciation expense for the amount of 6,000. And the parent shall recognize an amount of depreciation equal to 50,000 divided by 5 years. 50,000 divided by 5 years. The subsidiary will record a depreciation equal to 80,000 divided by 5 years. So that's now the cost to the subsidiary. Now for that, the subsidiary will record a depreciation of 16,000. That's why there is a difference of 6,000 concerning the excess of the depreciation recorded by the subsidiary of 16,000 over the depreciation expense to be recognized by the parent. So we have an amount of 6,000. And why do we debit accumulated depreciation? Because there is an overcredit. The fact that accumulated depreciation was recorded by the parent for 16,000. So we have now your answer to number 8. That's the last question. It's letter E for number 8. Now we go to number 9. Number 9, Pitonia Corporation owns 100% of Stone Company's common stock. On January 1, 20x4, Pitonia sold equipment with a book value of 210,000 to Stone for 300,000. So 300 is the selling price. The book value is only 210, meaning there is a gain in the amount of 90,000. Stone is depreciating the equipment over a 10-year life by the straight line method. The net adjustments to compute 20x4 and 20x5 consolidated income would be an increase or a decrease of. So we now have two columns, 20x4 and 20x5 for this computation. We begin with the column 20x4, unrealized gain on sale of equipment. Actually, this is parent selling to the subsidiary, meaning it's a downstream. Parent selling to the subsidiary. So first, we have the unrealized gain on sale of equipment. Under the column 20x4, we have negative 90,000. Unrealized gain, 90,000. Then, realized gain on sale of equipment. We have a downstream sale actually through depreciation. The gain is 90,000 and then we divide that by a life of 10 years. A life of 10 years. So we have 9,000 in 20x4, 9,000 and 20x5, 9,000. In question number 9, we are going to compute the X4 and X5 consolidated income, whether there's an increase or a decrease. So in 20x4, we have negative 90,000 for the unrealized gain. We only realize 9,000. So the net unrealized gain is 81,000. In 20x5, we have a realized gain of 9,000. So in number 9, our answer is letter D. Correspondingly, 81,000 unrealized gain and 9,000 realized. So we have unrealized, meaning it will decrease consolidated income, and we have positive, it will increase consolidated income. So the answer to number 9 is letter D. We go to number 10. The corporation owns 100% of Simons. On January 1, 2024, Patriot sold equipment with a book value of 350,000 to Simon for 500,000. So 500 minus 350, having a gain of 150,000. Simon is depreciating the equipment over a 10-year life by the straight line method. The net adjustments to compute 20x4 and x5 consolidated income would be an increase or decrease of. So we now have the unrealized gain on the sale. Again, it's a downstream sale. So you create two columns, x4 and x5. Unrealized gain on sale of equipment, 150,000. Negative, that's under 20x4. Unrealized gain on sale of equipment, downstream sale, negative 150,000 under column x4. Then we have the realized gain on sale of equipment, re- realized gain on sale of equipment for 150,000 divided by 10. So that's equal to 15,000. That's realized gain in 20x4 and 20x5. Realized gain 20x4 and 20x5. Now, what are the net amounts? For 20x4, 135,000. 135,000 negative, the fact that it's still unrealized. For 20x5, it's positive 15,000. So the answer to number 10 is letter D. Next, we go to number 11. Peace Corporation owns 100% of SEED. On January 2, 20x4, Peace sold machinery with the carrying amount for 30,000, sold for 50,000. SEED is depreciating the acquired machinery over a 5-year life using the straight line method. The related adjustments to compute X4 and X5 consolidated income before income tax would be an increase of. So again, we create two columns, X4 and X5. For the unrealized gain on sale, the unrealized gain on sale. This time, unrealized gain is equal to the amount of 20,000. So that's equal to 50 minus 30. So we have an unrealized gain of 20,000. Then we are going to record realized gain equal to 20,000 divided by 5. So that's 4,000. Realized under both columns. So the net amount for 20x4 is 16,000. That's negative 20 and positive 4. So we have the net amount of 16,000 for 20x4 and 20x5 for 4,000. So negative 16,000 for 20x4 and 20x5, positive 4,000. Okay, so we have those answers for numbers 1 to 10. Now we go to number 11 next. We have Number 11, the question is, the net adjustments to compute the X4 and the X5 income before income tax. So number 11, your answer in number 11 is letter A. Okay, we go to numbers 12 down to number 14. On January 1, Poxy sold equipment costing 100,000 to Saxi, a 100% owned subsidiary, for 48,000. At the time of the sale, the equipment had been depreciated 40,000 over a 10-year life using the straight line depreciation method. Okay? Saxi continued depreciating the equipment by using the straight line method over a life of 6 years. Okay, what are the cost and accumulated depreciation on this equipment? So we begin with number 12. The original cost of the equipment is 100,000. The accumulated depreciation on January 2, 20x6 is equal to how many years? Accumulated depreciation. If you have the original life of the asset equal to 10 years, so meaning it's 100,000 divided by 10 years. So it's 10,000 a year. And the equipment was sold on January 2, 20x6. Okay? So at the time of the sale, the equipment had been depreciated over 40,000. So you are already given the accumulated depreciation on January 1, 20x6. So 100,000 and the accumulated depreciation as of the date of sale is 40,000. Then we add additional depreciation in the amount of 20,000. Additional depreciation in the amount of 20,000. Since the problem is asking for the cost and accumulated depreciation respectively in December 31 X7 balance sheet. So the date of the sale was January 2, 20x6. The date required to us is December 31, 20x7. In other words, a period of 2 years.